Welcome back to the Safe, Simple, Sound podcast. We're diving deep into the financial pillars that keep your business standing tall. Now, I want you to close your eyes for a second. Unless you're driving, please keep them open and think back to when you were an employee. Remember getting that paycheck? You looked at the gross amount, then the net amount, and maybe you sighed a little at the difference. But honestly, you didn't have to do anything. Your employer was like a silent financial guardian, withholding your taxes and sending them to the IRS for you. But now, you've traded that security for freedom. You are the boss. And with that title comes a fundamental shift that shocks almost every new entrepreneur: the first tax bill. Today, we're tackling small business taxes, specifically the foundation of it all: income tax and how your business structure dictates what you pay. Here is the reality check. The IRS operates on a pay-as-you-go system. When you're the owner, there is no one withholding money for you. You have total liability. If you aren't prepared, April 15th isn't just a deadline, it's a panic attack. But don't worry, we're going to demystify this right now. Think of income tax as the baseline entry fee for doing business in America. But the way you report that income depends entirely on what species of business you are. First, we have the sole proprietorship taxes. If you haven't filed any special paperwork to incorporate, this is likely you. You and the business are one and the same. It's the simplest structure. You don't file a separate tax return for the business. Instead, you just attach a Schedule C form to your personal 1040 return. Think of it like wearing a backpack. The business is just extra weight or profit carried on your personal back. Next up, we have partnerships. If you're in business with a co-founder, you generally fall here. Partnerships file Form 1065. Now, here is a key term you need to know: pass-through taxation. Imagine a partnership as a pipeline. The business itself doesn't pay the income tax. The money flows through the pipeline directly to the partner's personal tax returns. You avoid double taxation because the money is only taxed once when it hits your hands. Then we have the corporations. If you are a C Corp, you are filing Form 1120. The corporation is a totally separate legal person. It pays its own taxes. But be careful, if it pays you dividends, you get taxed on that too. That's the dreaded double taxation. However, many small businesses choose to be an S Corp filing Form 1120S. Like partnerships, S Corps are pass-through entities. The profit flows to the shareholders, avoiding that double tax hit. Now, I know what a lot of you are thinking. Alex, what about my LLC? I set up an LLC to protect my personal assets. This is where it gets a little tricky, and it's a huge source of confusion regarding LLC tax filing. Here is the secret: the IRS doesn't actually have a specific form for an LLC. An LLC is like a chameleon. For tax purposes, it has to mimic one of the other structures. If you're a single-member LLC, the IRS treats you as a sole proprietor Schedule C. If you have partners, they treat you as a partnership, or you can elect to be treated as a corporation. So I want to ask you, how does your specific business structure dictate the forms you need to file this year? Do you know if you're a Schedule C filer, or are you supposed to be filing an 1120S? Understanding this flow, how the net profit moves from your business bank account to your personal return, is critical. If you don't know which bucket you fall into, you can't plan for how much cash to set aside. So, let's take action on this today. Here is your mission. I want you to review your business registration documents. Confirm your legal structure. Are you a sole prop, an LLC, a partnership, or a corp? Once you know that, identify the corresponding tax form. Is it Schedule C, Form 1065, or Form 1120? Write it down. Put it on a sticky note on your monitor. That form number is your roadmap. Once you know how to file, we have to talk about the biggest hurdle that trips up new owners: the hidden cost of working for yourself. It's the moment you look at your first projected tax bill and think, wait, why is this number so high? I thought I made decent money. Welcome to the world of self-employment tax, or as I like to call it, the solopreneur's burden. If you're taking notes, this is the hidden cost of working for yourself. Technically speaking, self-employment tax, or SE tax, is your contribution towards Social Security and Medicare. It's the safety net for your future self. But the way you pay it changes drastically when you leave the corporate world. Think back to when you were a W-2 employee. You'd get your paycheck, and it was already lighter than your gross salary, right? That's because your employer withheld taxes for you. But here is the secret your boss never told you. For Social Security and Medicare, you only paid half the bill. Your employer quietly reached into their own pocket and paid the other half for you. But now, you are the boss. You're wearing the employee hat and the employer hat, and that means you are responsible for the full share. Instead of splitting the cost, you are paying the entire 15.3% tax rate yourself. This kicks in the moment your net earnings hit $400 or more. It's a harsh reality check. You might be looking at your small business taxes and wondering why the burden feels so much heavier, even if your income is the same as your old job. It's because that silent partner, your old employer, isn't there to subsidize your Social Security anymore. So how do you handle this? You're going to calculate this using Schedule SE attached to your Form 1040. And it is crucial, really crucial, to understand that this is separate from your standard income tax. You can owe $0 in income tax because of deductions and still owe self-employment tax because you made a profit. Now, I don't want to leave you in a panic. There is a little bit of good news here. The IRS offers a relief mechanism called the employer equivalent deduction. Since a traditional business gets to write off the taxes they pay for their employees, the IRS allows you to deduct half of your self-employment tax from your adjusted gross income on your personal 1040 return. It's not a dollar-for-dollar credit, but it does lower your taxable income, which slightly mitigates that heavy tax burden. I want you to take a second and reflect on your current pricing or your salary goals. When you set your hourly rate, did you factor in that extra 15% off the top? If you're looking up how to calculate self-employment tax and realizing your margins are too thin, it might be time to raise your prices to cover that employer portion you're now paying. Here is your takeaway. Self-employment tax is mandatory, it is significant, but it is manageable if you plan for it. So here is my challenge to you for this week. Don't wait for the surprise. Calculate your approximate self-employment tax liability by applying the current rate to your projected net earnings so you aren't caught off guard. Look at what you expect to profit this year, run the numbers, and set that cash aside. And speaking of setting cash aside, knowing what you owe is only step one. The IRS doesn't want you to wait until April to pay it. Next up, we're going to dive into the pay-as-you-go system and demystify the quarterly anxiety of estimated taxes. This brings us to our next major pillar of financial sanity, pay-as-you-go, mastering quarterly estimated taxes. Now, I need you to forget everything you learned about taxes when you were an employee. Back then, April 15th was the big day, right? You filed your return, maybe got a refund, maybe owed a little bit, and moved on. But here is the reality check for small business taxes. The United States operates on a pay-as-you-go system. The IRS essentially says, we don't want to wait a whole year to get our money. When you had a boss, they took a slice of your paycheck every 2 weeks and sent it to the government. Now that you are the boss, you have to do that for yourself. There is a massive myth floating or wait until tax day to pay your entire annual liability. Debunk that right now. If you wait until April to pay everything, even if you have the cash on hand, the IRS is likely to hit you with an underpayment penalty. It's like paying a late fee on a bill you didn't even know was due. So, who exactly needs to worry about this? It all comes down to a specific monetary threshold. If you are a sole proprietor, a partner, or an S-Corp shareholder, you need to make estimated payments if you expect to owe $1,000 or more in taxes when you file your return. Think about that, $1,000. If your business is even moderately successful, you will hit that number very quickly. For corporations, the leash is even tighter. The threshold is just $500. So, how do you actually do this without losing your mind? You need the right tool. That tool is Form 1040-ES. Think of Form 1040-ES as your quarterly invoice. It's not just a payment slip, it's a worksheet. It helps you calculate your expected income for the year, divide the tax owed by 4, and tells you exactly what to send in. These payments are generally due in April, June, September, and January. I want you to pause for a second and reflect on your cash flow right now. How many of you treat your business checking account balance as available spending money? It's a common trap. You see $5,000 in the account and think, Great, I can buy that new equipment. But if $1,500 of that actually belongs to Uncle Sam, you're spending money you don't really have. Here is a cash flow strategy that saves lives. The tax vault. Open a separate high-yield savings account. Every single time a client pays you, whether it's $100 or $10,000, immediately transfer a percentage, say 25% or 30%, into that vault. Do it before you pay your bills, before you pay yourself, before you buy coffee. When those quarterly estimated taxes roll around, you won't be scrambling to sell assets or dip into your emergency fund. You just transfer the money from the vault to the IRS. You turn a financial crisis into a simple administrative task. Ask yourself, what systems can you put in place today to ensure you have that liquidity when the deadlines hit? Are you relying on hope, or do you have a plan? To wrap this up, the annual surprise is only a surprise if you aren't paying attention. The system is designed for you to pay as you earn. By respecting the thresholds and using the right forms, you stay off the IRS radar and keep your penalties at zero. Here is your mission for today. Download Form 1040-ES immediately. Even if you don't pay today, look at the form. Then open your business calendar and mark the 4 quarterly payment deadlines. Set reminders for 2 weeks before each date. Do it now, and your future self will thank you. All right, take a deep breath. We just finished talking about quarterly estimated taxes and how to handle that pay-as-you-go rhythm for your own income. If you've got your Form 1040-ES ready, you're already ahead of the curve. But success brings its own set of complications, doesn't it? As your business grows, you might find that there simply aren't enough hours in the day to do it all yourself. You need help. That brings us to our next major topic, growing pains, employment and excise taxes. Here is the reality check. When you hire your first true employee, your relationship with the government changes fundamentally. You stop being just a taxpayer, and you start becoming an unpaid tax collector. It sounds harsh, but that is essentially what employment taxes are. When you have staff on the payroll, you are responsible for handling the big 3. First, there's FICA, Social Security and Medicare. You have to withhold the employee's share from their paycheck, and then you have to reach into your own pocket and pay a matching amount. Second, you have to withhold their federal income tax based on their W-4. And third, there is FUTA, or Federal Unemployment Tax. Unlike the others, you don't take this out of their check. You pay this entirely from your own funds to fund unemployment compensation. Now, I can hear some of you thinking, Alex, that sounds like a nightmare of paperwork. Can't I just hire them as a freelancer or an independent contractor? This is where I need you to listen closely because this is a trap that catches so many new entrepreneurs. There is a massive difference between an independent contractor and an employee. And it's not just about what title you give them. It comes down to behavioral control. Ask yourself this guiding question. Are the workers you hire truly independent, or do I control enough of their work to classify them as employees? If you hire a web designer, tell them what you need, and they deliver it next week using their own laptop at a coffee shop, that's likely a contractor. But if you hire an assistant, require them to be at your office from 9 to 5, provide them with a computer and give them step-by-step instructions on how to answer emails, that is an employee. If you misclassify an employee as a contractor to avoid dealing with payroll taxes and the IRS finds out, you could be liable for all those back taxes you didn't withhold, plus penalties. It's a financial hole you do not want to dig. Now, for those of you effectively managing a team, you'll generally report these withholdings using Form 941 every quarter. If you're a very small employer, the IRS might let you use Form 944 annually, but usually it's a quarterly ritual. Before we wrap this up, there is one final, smaller bucket called excise taxes. Think of these as niche taxes. These aren't based on your profit, they're based on what you do. Excise taxes are levies on specific goods or activities. So here is your second guiding question. Does your business engage in niche activities, like manufacturing specific goods or operating heavy vehicles? If you operate a trucking company with vehicles over 55,000 pounds, you're looking at Form 2290. If you deal in fuel, indoor tanning, or accept wagers and lotteries, you might need Form 720. For most digital solopreneurs, this won't apply. But if you fall into these categories, failing to file can shut you down fast. So let's bring this back to your business today. Growth is great, but it requires structure. You need to know which tax forms like the 940, 941, or 720 are lurking in your future. Here is your call to action for this segment. I want you to audit your current roster of workers and vendors. Look at everyone you pay. Are you treating anyone like an employee but paying them like a contractor? If the answer is maybe, talk to a pro and fix it now before the IRS fixes it for you. Knowledge is control, my friends. Once you have your team classified correctly, you can get back to building your empire with peace of mind. And just like that, we've demystified the 4 big buckets of small business taxes. We covered a lot of ground today, starting with the foundation of business tax types. Whether you are navigating LLC tax filing or managing a simple Schedule C form as a sole proprietor, knowing your structure is step 1. We also shone a light on the hidden cost that catches so many off guard, self-employment tax, and broke down exactly how to calculate it so you can protect your bottom line. Most importantly, I hope you're walking away with a strategy for quarterly estimated taxes. By using Form 1040-ES and embracing the pay-as-you-go system, you can finally put an end to the fear of that annual surprise. Remember, understanding the distinction between an independent contractor versus employee or knowing when to file isn't just about following the rules. It's about seizing financial control. If you're ready to take action, head over to the show notes. Also, contact us if you would like a checklist for first-year business tax preparation to help you get organized. If this episode helped lower your blood pressure, please leave us a review and share it with a fellow entrepreneur who might be stressing over their books. This is Alex from Safe Simple Sound, signing off.